Good evening and welcome to the BizNews Briefing. Today is Wednesday, the 18th of February. I'm Kerry Lanigan. On tonight's show, the political and funding fight behind Gauteng's water crisis, Blue Label's new route to market for private power, a bumper SENS day led by Glencore and the gold counters, Bloomberg on how AI disruption fears are driving wider market sell-offs, and we bid farewell to a BizNews Tribe favorite, Clem Sunter. Our top story tonight. The DA's spokesperson on water and sanitation, Stephen Moore, sat down with BizNews journalist Chris Steyn yesterday. He looked at the finances and logistics involved to turn around Gauteng's water crisis.
So there's various levels. At a local level, I hesitate to say this, but it's possible to say that the current mayor has allowed Joburg Water to put in place a good plan. So there's a good plan in place, which is great. But a plan without financial backing won't go anywhere. That's the reality here. Words don't move worlds, money does. And we need to see major shifting in the budget, not minor shifting. There has been some shifting, but it's still less than half of what they need on an annual basis for the next 10 years in order to catch up. And remember, the longer you don't put the money in, the more the system decays and that number ticks up. So from a Joburg perspective, they need to tighten their belts in other areas. It's what we did in government when we were in Johannesburg. We tightened our belt. We gave other departments a bit less so we could pump more money into City Power and Joburg Water. And that's why when we were in charge of Joburg Water, the number of leaks went down every year. Only a little bit. I think it went from 48,000 to 47,000 one year and 47,000 to 46,000. But going down, getting better, is a lot better than the over 100,000 leaks that are currently happening in the city since it's been under different control. But beyond the municipality, Chris, and I think this is important, is that there are levers in other areas. This is a disaster, and I think it needs to be treated as such. There's the ability to shift money around at a provincial and national level. It was done for eThekwini when they had the floods. But particularly it was done not for beautification, it was done because they had a water and sanitation disaster. Does that sound familiar? They had a water and sanitation disaster. So they got, I think, 1.7 billion rand of disaster funding to help fix eThekwini. Now, that type of money spread across particularly Tshwane, which is an accelerating disaster. Joburg's been a disaster because of its size, but Tshwane is a disaster because of how fast the infrastructure is decaying due to neglect or other influences. So those are the two primary ones which need a lot of attention. And there's various grants. I don't want to prescribe it because if I say they should use the municipal infrastructure grant, then they'll say, no, that's not what it's for. But it has been used for that type of thing beforehand. There's the Water Services Infrastructure Grant from the Department of Water and Sanitation. That can also be shifted. There's various bits and pieces that aren't normally intended for this, but have been used for it in the past. And Chris, Joburg is too big to fail. It's our economic hub. Because if Joburg isn't working, Gauteng isn't working. And to be blunt, Joburg gets the media attention, but Ekurhuleni is feeling this pain. Massive industrial center. Tshwane, the capital of the country, is feeling this pain. And the smaller municipalities, they don't get any of the love. But I promise you, they are getting it even worse because Rand Water and everyone know they don't get the attention.
Speaking to BizNews editor Alec Hogg yesterday, ShareNet Wealth, still in Bradfield, unpacked Blue Label's new capacity to sell non-Eskom power to municipalities.
Yeah, it's the unicorn. It's the unknown right now. I mean, I think post earnings results at the end of the month, we'll have a bit more gateway to ask the questions. But from early interactions we've had, this is something that's been 3 to 4 years in the making. That converted a couple of municipalities across. And I think one of the easier ways to think about it is you've got a big brother that's going into the municipalities where Eskom has failed horribly. That's there to revive the services, to make sure that all the prepaid electricity is accounted for correctly. The gateways are paid for. They've hired, through government subsidy, circa 10,000 employees that will effectively roll out into the country for illegal disconnections or connections to disconnect all of those, put the new prepaid meters within that they service, and that's pretty much their whole gateway. And then you've got, as you said, the IPP that's going to be coming through where you can sell and distribute electricity to areas that need it. I think it's a fantastic thing for Blue, but I think it's a fantastic thing for South African economy on a whole.
It sounds like it. It sounds like we've been stuck with this Eskom monopoly for a long, long time. And the IPPs, the independents, haven't been able to really break through. But this would give them a route to market.
Yes, absolutely. It's an exciting, we don't know the exact timeline and how this will start to focus and to roll out. But I think, as I said, they've already interacted with a couple of municipalities. I think it's a couple of months versus a couple of years from where we are now.
Finalizing your February tax planning? Gauteng's latest Section 12B solar investment offers taxpayers a tax deduction of up to 230%. In simple terms, for every rand invested, up to 1 rand can be deducted from your tax bill, while you continue to earn income from solar assets. This applies to both income tax and capital gains tax. Visit gauteng.co.za to find out more.
Next up, highlights of today's news from JSE-listed companies. And we bid farewell to a BizNews Tribe favorite and one of South Africa's most influential scenario planners, Clem Sunter.
Sad news tonight. Renowned South African futurist Clem Sunter has died. Sunter passed away this afternoon following a brave battle with pancreatic cancer, which he fought for over a year. Best known for his high road scenario planning in the 1980s, Sunter played a pivotal role in shifting South Africa's mindset from conflict to negotiation. A former Anglo-American executive and best-selling author, he taught a nation to think like a fox, adapting to the unknown. Our thoughts are with his family. And he leaves us with an appropriate sign-off.
And I always end now any webinar or something I do with a blessing. May the fox be with you.
Well, it's been a bumper day for news on the JSE, with mining heavyweights and smart deal makers showing us exactly where the value lies. First up, mining giant Glencore proved today there is plenty of life after coal. CEO Gary Nagle delivered a rock-solid set of numbers, with operating profits hitting a massive $13.5 billion. But the real story here is the pivot to copper. They're targeting over 1 million tons of copper production by 2028 to feed the world's hunger for green energy. Despite softer coal prices, profits surged in the second half of the year, that is to December 31, allowing Glencore to hand $3.5 billion back to shareholders. That includes a special top-up dividend, a very sweet cherry on top. The wise ones say you should follow the money, and today it flowed straight into the Roodepoort rocket, DRD Gold. Chief Executive Neil Pretorius has shot the lights out. His team virtually doubled their headline earnings to 1.9 billion rand, even though DRD actually produced less gold. How? Well, the gold price surged. Those bumper profits paid for 1.5 billion rands in new projects without the company having to borrow a single cent. And shareholders still pocketed a handsome 50 cents a share dividend. That's for the 6 months to the end of December. Staying with a yellow metal, if you want to see what a record gold price does for a well-run miner, look at Pan-African Resources. Kobus Lutz and his team posted a staggering 212% jump in interim profits, that's the 6 months to end December, to nearly $150 million. Production is up 50%. They've slashed their debt by 2/3 and declared a healthy dividend. It's a textbook example of making hay while the sun shines, expanding low-cost production just as the gold price hits the stratosphere. Remember the JSE-listed company Capital Appreciation? Well, under its new name, Araxi, they've just announced a blockbuster deal. They're putting down a cool 1 billion rand to snap up 80% of the Payat group. If you've ever paid a bill at a retailer, you've likely used the Payat system. It's a big bet for Araxi, funded mostly by debt. But here's the kicker. They're buying this asset back from an American private equity company. It brings the tech back under South African control, and the profits from Payat should comfortably cover the interest bill on the 800 million they are borrowing. And finally, Grindrod is firing on all cylinders. In a trading update today, the company flagged that earnings have rocketed over 100%, hitting more than 2 billion rand. While a big chunk comes from one-off accounting gains, the core business is humming. Profits from Grindrod's actual operations are up around 20%, driven by record volumes at the Maputo terminal. It's a clear signal that the logistics logjam is finally unlocking for those with the right assets.
Robertson, a small town in the middle of nowhere where a wine farmer claims to have sold a Volkswagen up to WeBuyCars. A farmer. What car did you really sell them?
A VW.
Right here in Robertson.
Small town, but we know about WeBuyCars.
Yeah, but what's a farmer doing with a VW up?
It was just a runaround.
Cool cover story. And I see you traded it in for this, like a double cab Denay. Were they all out of ranges?
WeBuyCars, the easiest way to sell your car by far.
And closing out tonight's show, our partners at Bloomberg explain why AI disruption fears are spreading beyond tech. Wall Street is now whipsawing between concerns that AI costs too much and concerns that it could disrupt more industries faster than expected.
On Wall Street, rising fears about artificial intelligence and specifically where it will disrupt certain companies are sending shares of those companies tumbling.
Wall Street has done an about-face. Investors were concerned that AI was costing too much and might lead to a big bubble with untold harms. Now investors are concerned that AI is going to be so disruptive that it renders countless businesses obsolete. There's definitely been a spillover, starting with concerns about legal services, SaaS companies heading into insurance firms, tax preparation services, financial services, each of these in reaction to incremental AI products. The market sell-off really started in early February when Anthropic introduced a plugin to an existing product, one that they did not even really do a formal announcement for.
So what we saw on February 10th, for example, was shares of wealth management companies sell off after Altruist, which is a little-known AI startup, came out with a new tax strategy tool. Look at the stock slides of companies like Salesforce, Charles Schwab, and Blue Owl. Investors are concerned that AI might be able to replicate their offerings soon. The fear for investors right now is that they're going to get caught up in the next version of this sell-off, and so they're really looking for ways to avoid that.
Let's take a step back. In November of 2022, OpenAI kicked off the AI boom. When ChatGPT launched, people were mainly using it to spit out clever song lyrics and poems and pithy responses to things. But what we've seen in the last year or so is that people have been using these to shop for products online, do more advanced online research, and even build apps from scratch with little expertise. Wall Street now seems to be waking up to the fact that those same tools can be used across different sectors.
These tools are coming out and they're good. And so what we're seeing is investors really worried about the parts of the market that are tied to AI risk and looking instead to go more into the AI winners. This chart depicts two baskets of US listed stocks from UBS research analysts. One is AI winners and one is AI risks. So you can see there's been a massive divergence as investors look to avoid companies associated with these risks and flock towards the AI winners.
That technology has been very disruptive in a certain corner of the world, particularly Silicon Valley. But in recent months, it feels like there's been a mainstreaming of it, where we're seeing broader awareness, right? You can use that same technology in your everyday life or in other sectors, even if you don't really want to code.
We've seen video game stocks get hit after a new Google Gemini launch. We saw insurers get hit after a startup came out with a new product. And even more recently, real estate stocks are selling off as investors think that this could be the next place that's going to get hit.
At the moment, Wall Street seems to be whipsawing between two different, extremely opposing views. There are investors who are concerned that tech companies are spending too much money to build AI services with an uncertain payoff. On the other side, investors are anxious that AI will be so disruptive that it renders numerous businesses obsolete.
I've definitely heard sources say that they just don't understand how both of these things can be true at once. They don't think that these knee-jerk reactions would be happening if we weren't near record highs on the S&P. We don't know what next feature or new product is going to be released that sets off the next sell-off, so really we're just watching to see what happens next.
Unsurprisingly, it's hard to predict where things go from here. What's clear is that the large AI developers and a long list of AI startups plan to bring advances to more and more sectors as they try to make money from this technology. So we should expect that if Wall Street is now worried about how disruptive AI could be, there will be plenty more moments in the months ahead for them to be concerned.
That's been tonight's BizNews Briefing. I'm Carrie Lanigan from BizNews.com. Thanks for watching, and we'll see you again tomorrow.